Welcome back, everybody, to another fantastic update from our experts, sharing with you what has changed since the start of 2021 and what has changed that is going to impact their original forecast made in December 2020 to help you on your property investing journey. Now, today we're joined by an excellent panelist, Mr. David Clouter, who will be interviewing with myself, Jay Howard. Now, Jay, you're well known from being from an auction background. You actually run a business called Hammered, and you're a consultant to auction houses. So could I crudely say that you're a bit of a property trader type, given that our prior conversation to this interview was a deal that you cheekily put through auction yesterday and sold. So going back to December, we had a little chat and you helped our audience. Did you personally have chance to watch any of the other interviews at all?
You know, I did. I listened to, I always find it interesting what Adam Lawrence has to say. He does his Sunday supplement on the Partners in Property page, and I look forward to Sunday mornings and a cup of tea, and I sit down and digest it. He's got a phenomenal mind, and it's always good to he picks up undercurrents very, very well. So always find that valuable chat. I listened also to the John Corey one, and obviously we're going back a number of months now. And it's always interesting hearing John's view on things because, he comes at it from a very kind of different field, but it's the way he applies it. So I always find that interesting. And I think it's just always good to hear other people's perspectives. And of the ones that I'd listened to, and I can't remember all the ones that I'd listened to, but I did listen to a fair few. Everyone was almost saying roughly the same kind of thing, just in different language, for the most part, at least, which is encouraging because it means I'm not too far out there. But at the same time, it was I almost wanted to hear something that I didn't want to hear. But it's good because everyone was coming at it from a different sphere of knowledge and experience, and a different viewpoint based on where they see their risk and reward or what strategies they employ. Very helpful for me, 100%.
And you're not the only one, I have to say, Jay, who of our interviews who watches what the others have to say. So it's quite a little kind of forum we've got going here. And as you say quite correctly, people are coming at it from different angles. And if the conclusions that they draw are broadly the same, then that gives us quite a lot of optimism moving forward in Q2. So let's see if it happens this time around.
So let's wind the clock back, Jay. It's December. We're carrying out this interview and we were pontificating on a Brexit, no Brexit, deal or no deal. Now, did we get that one right, do you think? Do you think it's been a positive outcome, or do you think from a property perspective this is, or do you think it's basically been the worst thing that could have ever happened to the property market?
Well, I think property for us in the UK, and then trying to apply that to the European standard is really very difficult, because the truth of the matter is we're an island, so whether you're part of an economic community and a trade community and a freedom of movement of people's kind of community, the property element is almost separate. What I didn't expect was the kind of political guerrilla warfare that Gordon, I was going to say Gordon Brown. That's just ridiculous. It's just a fat politician who came out of nowhere.
Remember him, Jay.
I remember he sold off massive amounts of gold reserves before it hit the highest gold standard in a couple of 100 years. But I'm not casting negative aspersions against Mr. Sausages. But no, Boris Johnson is the one we're talking about. Because he held everything to the very last minute, and it was a game of chicken.
Yeah.
And the fact that they decided to actually go ahead and do a deal and now go through the 2 year of all the other bits and pieces, I think no deal would have been disastrous. And I don't think the deal that we have is the worst case scenario, but I think these things need to be worked out. You know, there's an element, and, you know, being a bit of a lord of chaos, probably within my own mind, I quite like the fact that Brexit happened, because I like creating a little bit of instability, because, you know, it's the old Sun Tzu quote, you know, growth, whether internal or external, requires, you know, a breaking down of something, a destruction of something to grow something else out of it. You know, it's the Phoenix model.
Yes.
So there's a part of me that likes that. There's a part of me that appreciates it's not ideal, and it's going to cause issues for a lot of industries and a lot of businesses and a lot of livelihoods. And actually, I think the stubbornness of the UK government and the European community has caused a lot of that, because no one sat down as grown-ups and said, we've decided to do this. We've been together for a good couple of years. We don't want another war. Why don't we do something nice and just do an amicable divorce? But, you know, on a political level, they couldn't handle that.
Yeah.
Well, we're still in we're still in NATO, of course, so we're not going to have a war. The recent vaccine debacle was very unfortunate, I think, and that's obviously created a bit of ill feeling that's going to percolate through. Not very good PR for the EU. But the point I'd like to make is that when we're a member and when we're not a member, there's a huge difference between mainland Europe and the UK in terms of people's attitude to property ownership and whether people like renting. There are far stronger laws protecting renters in the EU and on the domestic front, and there's less of, perhaps therefore, of an I don't know which chicken and egg which comes first, but there's just less inclination, less drive for people to own their own property over there, and that will always be so, I guess.
Yeah, but you're hearing, especially in the UK, they want the end of generation rent, which is not the best thing for a landlord to hear. But, you know, it harkens back to the old Maggie Thatcher thing of, you know, this is a council house. If you want, you can buy it. Restrictions, etc., etc. The truth of matter is, the UK property market, and it's difficult to see. You know, the UK government have come out with the additional 2% stamp duty land tax for foreign nationals. So that itself is obviously a way for them to kind of, you know, unchoke the coffers, and, you know, it's a hidden tax to Europe. Obviously, it's blanketed for the rest of the world, but it's a hidden tax to Europe, 100%. And then the other thing that to consider for me at the moment is, we've had the slowest capital growth in the country's capital for God knows how many years, and people are like, oh, you know, you can get better yields and better capital growth in here, there, and everywhere. And I'm thinking, if you're all leaving London, I know where I want to be, and on top of that, I know where international investors are going to want to be. They're going to want to be picking up property that hasn't had much capital growth in the last 2 to 3 years. The rents aren't great. You know, if the Mayor of London gets rent reforms or rent controls in place, God knows what's going to happen there. I don't think it's worked out well for Germany or parts of Germany. I can be corrected. I know it's been the status quo in New York for God knows how long, but it's a completely different legal and property-centric environment. So it has to work for the environment that you're in.
So if you agree with Jay on the fact that the legal and regulatory framework is better, and that having rent controls in London would be a good thing, tell him. And if you don't agree, tell me, because we'll have a bit of a debate on this in the near future, Jay.
Just be really very aware. Just for me to clarify, I am not a fan. I don't think it has worked at all.
I would agree.
The problem that you have with rent controls is the way the UK market the USA market works is that they buy massive housing kind of estates, and then there's consortiums and all this stuff behind it, and the rent is fixed and registered and all this other stuff. But then it's always sold on multiples plus something else. I can't remember exactly how it works. That's not how the UK works. The UK works on either a pound per square foot basis, if you're in a place like London or most cities, centralized cities in the UK. And then it works on a yield basis, generally. But also, if you're looking at a pound per square foot basis, you're also looking at capital appreciation over X period of time that you're looking at owning it. That, of course, only really applies to people who are building portfolios and holding for 10, 15, 20, 25 years, etc. You're someone like me who tries to be in and out of a property within a couple of weeks, let alone a couple of months. It doesn't really apply, although it did apply in the early 2000s when the market was rocketing pre-2000 to the 2007, 2008 crash, where literally you could buy something one day and at the end of the week it was worth £30,000 more. Like there was no failing in that market until, of course, the entire market failed.
Wow.
But that was, we're not going to talk about this, but that was knock-on effects from Fannie Mae, Freddie Mac, BlackRock, and 125% mortgages and all that rubbish, which obviously post that crash doesn't happen anymore. No. So, you know, it's the lending and it's the exposure to subprime markets that kicked all of that off.
Well, I was going to say Europe and the US, the way they fund investments of, as you've just described, is different to how we fund it here in the UK, because we have a different financial regulatory authority. So without getting too bogged down in Brexit and occupation, we're looking at this from a property trader's point of view, because that's your core strength. That's what you're passionate about, Jay. Now, since the last time we did a review, where I think you described it as there'll be turbulence, there'll be lots of speed bumps, there'll be good news, there'll be bad news. We've had a budget. Today, we've had a planning announcement on the new Class E rules. What do you think of the budget? What do you think of the post-COVID environment? I mean, if I throw a spin onto that, I've been analysing the spat in Europe between the UK and Europe. And the thing I've observed is lots of companies are now saying, actually, we don't want to base ourselves in Europe. We want to come out, because if they play funny buggers on contracts, like all the vaccine ones, and you've got Novavirus or Novavax, who said, actually, we're not going to sign a contract with Europe because we don't like the rhetoric. Now, that's going to have surely a positive effect on inward investment into the UK. Would that link in with what you are seeing within the budget that was announced?
Well, the budget I actually thought was actually fairly positive. There was some, you know, what they're trying to do is last time there was massive market uncertainty, they all of the helicopter funding went to institutions. Banks were top funded out, you know, all bar, you know, the likes of Barclays and people like that who took large amounts of money from the Middle East, you know. But this time they've gone, right, how do we actually keep money in people's pockets, keep them consuming, and keep the economy moving? They wanted to freeze up, and they knew it was going to freeze up to a degree because they'd locked every bugger down. so you know, they've slammed on the brakes, but they're still lubricating the cogs, and you find yourself in a bit of a smokescreen situation there, because you know the engine's running, but it's just not going anywhere. So actually, by creating all of these incentives, creating all of these packages that they're bringing out, all of the, you know, even if you look at the furlough stuff, even if you look at the grants that have been given to SME businesses and all of these different types of things, that's positive. But if you then bring it back to property, and this is an area of property that I'm not necessarily in for more reasons than we would have time in an evening to go through, but if you are a buy-to-let landlord and you were not that great with your referencing, or you didn't mind who was renting your property, and just get the room let, get the income coming in, get the rent roll rolling, and you found yourself 50% of your tenants had just overnight stopped paying because they were given the opportunity to. 18 months later, they're still sitting in your property, they're still not paying.
Absolutely.
Is that coming out of your own pocket? Has your mortgage company given you a holiday for that time? Repossessions are frozen, evictions are frozen, and these things have defined deadlines that just keep being kicked further down the road. And it's the same thing with the stamp duty. They didn't want to create that cliff edge, but no one paid attention to the cliff edge for the first 8-9 months it was in operation for. Now they're stepping it down, and that's had an impact. You know, if you look at the January, February, even now the March auctions, up until the first week in March, where I think 3 or 4 auctioneers, you know, Auction House London, Savills, and 1 or 2 others, created an additional auction to make sure that they could have an extra sale to allow people to complete in advance of that stamp duty deadline. And it was all for naught, because 2 weeks later they extended it.
Well, I think, I mean, we did interviews before Christmas. I did a particular one with Ranjan, and in that interview, you'll actually hear me say, my belief is what will happen is Rishi will kick the can down the road. And I stated 6 months. And I also stated what he will most probably do is make a step there. So it will go down from the 2% to 1% down to 0% again, discount on that. So from our expert reviews, we have actually forecast and predicted that one quite accurately as a group of expert investors.
Yeah, I mean, a lot of it wasn't necessarily difficult to see. There were some things that came out of the budget that I don't think many people had expected, but I think is positive. I mean, the truth of the matter is the auction market is really hot at the moment. At least, you know, if you're a seller, unless you completely balls it up and buy in at the wrong price, you're going to do well because there's cheap and easy money out there. People are very, very liquid. You know, one of the things with the lockdown is that people can't really go anywhere and spend their money on experiential kind of bits and bobs. No, and why not invest in property? You know, you kind of, one of the things I wasn't expecting, and I wasn't expecting it because, you know, it's one of these things, you know, you don't know what you don't know. I knew nothing about Freeports.
Okay.
Absolutely bloody nothing about Freeports. Probably because of my age, because last time Freeports were around, I was nothing but a glint in my father's eye. So I forgive myself somewhat, but I've been reading a lot about Freeports. Bloody amazing.
Well, if you look at Freeports, Jay, I mean, I did a talk on this probably 8-10 weeks ago. I was thrown a question during a live talk, and a Freeport is effectively a new name for an enterprise zone that we already had, but actually there are Freeports and been kicking around until reasonably late anyway, but they were only small projects.
Yeah,
this has been expanded on steroids.
Oh, completely. I mean, I'm now starting to look at other areas of the country where the benefits of investing in those areas with you know, they're already saying we're going to be putting 5.6 billion here, we're going to be putting X amount of hundreds of millions here, we're going to be, and I'm sitting there thinking, well, you know, everyone's following. Remember the days when everyone was following the HS2, like the route. Okay, we need to be investing along the HS2 because it's going to be a cash cow. I mean, it'll be my great-great-grandchildren's pleasure to ride on that HS2 if ever bloody happens. It'll be HS 2000 by the time it comes into fruition. But you know, it's one of these things. These Freeports, because it's, you know, it's a rebranding of an existing thing that we had, but also it's a rekindling of something from, you know, post World War II. It's something that has a foundation in value and has a foundation in something that will actually have, I think, in property, a positive impact in certain areas. So I think that's, oh, and if you're already invested in those areas, like I know, like in around the Coventry, Warwickshire, Leamington Spa, that's going to be there's a Freeport kind of thing being brought into there, and I know you're fairly active in the area, Andrew. I would be sitting there like, I would be like this. Well, I will see you guys in the Bahamas. I mean, obviously it's going to take a while, and there's a lot of these things that have to filter through. But you know, if you're lucky enough to be invested, like I think Birmingham's one of them, then obviously you've got Kent. I think I can't remember exactly where in Kent, but there's several others as well.
A favourite investing area of Hull.
Yeah, I mean, and you know, I mean, Hull was what the city of culture or something.
Culture 2 years ago. Yeah.
It's the jewel of the northeast, of course.
Well, I think what you've done here, Jay, is you've hit on one of those things, and us as slightly smarter investors than people who don't look at the macro picture, is we follow politics, not prices. We don't go buy in an area where prices are rising. They're rising because the politics has made the area rise. We follow the politics. The Freeports is where it's going to rise. Let's go grab the inventory now, and that area will rise, and we'll bail out as it's rising.
Yes, I mean, as contrarians, we are selling in those rising markets. If selling is our thing, we're certainly not buying into them, are we? And there's a sense in which the government has to show the world post-pandemic, post-Brexit, and so forth, that UK PLC is still open for business. And there will be a day of reckoning, as you said earlier, Andrew. There has been some kicking of the can down the road. There are a lot of pre-budget rumours this year, which got everybody jittery a bit, and maybe that will some of that stuff will come to fruition in the autumn. So that there is a sort of Damocles hanging over it. But you know, Q2, it's hey.
Exactly, and I think, you know, when you're talking about having a look in August, there's definitely room for stealth taxes to be filtering into the system, even now. And I imagine those won't be addressed until, like, quite, let's just say, Q3. And I think if you pay attention, you understand the dynamics of it, you'd be expecting it. But there are ways to not protect against it, but to know it's coming and prepare for it. It's those who don't know it's coming and don't prepare for it that they end up caught out somewhat.
Yeah.
But, you know, for me, you know, if the UK is smart, every time that there is a breakdown, so, you know, you had the old USSR, and then you had all obviously half of Eastern European break away from Russia, right? You know, Poland was considered, you know, the gateway to Eastern Europe and Russia, right? And it was, and you've got Qatar and places like that are considered the gateway to the Middle East. I don't see why the UK can't be the gateway to Europe, especially if you're looking across, you know, from the Americas all the way over to us. Very easily could be the gateway, you know. And you know, the English Channel and the Northern Sea, you know, we are primarily placed to be that gateway, and it all comes down to how the politics can position that and survive that. I haven't got a great deal of faith, because I think, you know, it's one of these things, you know, what you do to get from A to B necessarily won't get you from B to C. And I think what's been done now to get us from A to B, whether it's comfortable or uncomfortable, won't necessarily get us from B to C. So it'll be interesting to see what is required to grow. And as you say, make sure people are aware that, you know, UK PLC is still very much up and running and up for business.
Well, you mentioned that there's going to be some politics kicking around. Looking towards politics, one of the things that the government has done in this quarter, which was a little unexpected, is they've said, right, all central government departments are going to move them to the regions. I would have thought one key department to stay in London would be Treasury, because the Bank of England's there, the financial part of the country, but we're moving it to Leeds. I think tactically it's very good, because it's saying government is where the people are. On the flip side of it, it's creating employment and jobs in those regions. But what do you think? Is that a good idea? Because communication could go down the pan. or will it all jump on Zoom?
Well, I mean, I 110% believe it's a good idea. I absolutely do. I think, the folly of 2007, 2008 showed the country that we had an over-reliance on the London market as a support and a bolster for the rest of the country. Whether the Northern Bloc want to hear that or not is a nothing of a nothing. But what is important is it highlighted how necessary it is to have a codified and strong financial market and GDP covering that northern and mid section of the country. Of course it's foolhardy having everything bottom heavy. You want that chakra line running up and down the country of different points where there are independently sustainable markets and growth points, which will only be good for the GDP.
And of course, a cynic might say that the Conservatives have won a lot of seats north of Watford in the last election. And if Boris wants to maintain his 80-seat majority, he's got to really see some wealth moving in that direction.
Two birds, one stone. And why not? Oh, yeah. It makes good economic sense. And, there's probably 15 other reasons that are hidden behind big, heavy doors at number 10 that we'll never know about. But on a superficial and surface level, it 110% makes sense. It actually, when I was very, very young into investing, I used to do a lot of trading in Leeds. I think Leeds is a great market. People that whole Leeds, Liverpool, Manchester kind of down across through Birmingham. I think that's a brilliant kind of swathe of the country. Why not? And actually, when Brexit first started off in 2016, the amount of multinational companies that left warehouses and manufacturing plants and all of these things in these traditional kind of industrialized towns in the north, which FYI grew the country from the 19th century to where we are today. That pushed the Industrial Revolution. So it's important now that we look at those environments. We say what is needed to make these metropolitan, locations bolster points for international businesses to want to come and invest and be there and grow. And it's 100% needed in order to, and it highlights that the UK is open for business, and not London PLC is open for business. UK PLC is open for business.
Well, you've got two distinct zones that companies will want to relocate to, either a free port for the benefits of the free port that it offers, or you have the areas where government departments base themselves because they feel if they're a pharma company, they might want to base themselves near where the Department of Health are relocating to. Therefore, it's easier to lobby and they're out in the region with them. So it will be good for restaurants, it'll be good for house prices, it'll pull it all up. But will that create a vacuum in London? There's an interesting thought for you, Jay.
You know what, I mean, I've already touched on the fact that capital growth in London, not on a decline, but certainly not on a growth. And I wouldn't call it a plateau, I'd call it a flat line. And especially in this market, and that's fine because it needs to repair, because actually it had unsustainable capital growth realistically from 2012, which is a really quick growth point from a 2008 crash. It's only 4 years. And, you saw the heat of that in 2014, you saw the heat of that in 2016, obviously until the whole Brexit thing brought in some turbulence. But that hasn't dissipated since at least 2019. And obviously we've seen a year and a bit of that reduction. Maybe it needs a year a bit more, certainly a year a bit more before I start buying there. But actually what it does is I think it creates a microclimate for international investors. I like the Hong Kongolese. I don't know if that Hong Kongolese is the right word. Foreign nationals from Hong Kong, who have been, the British government have said, oh, we've got 2 million passports to hand out to people in Hong Kong. From January till about 2 or 3 weeks ago, 350,000 have already applied. That is a lot of foreign wealth and money, and before you take the wealth and the money out of it, you also got to think about the level of education in Hong Kong, which is brilliant, FYI. So you're bringing in more cultured, more educated people into the workforce, into industries such as medication, R&D, sciences, all of this kind of stuff, and obviously loads of others, but you pick the ones that we have a bit of a dearth of in the UK. And that for me is brilliant. And they will always look to start London. And if they're not going to live there, they will be buying investment there, because they know long term, you don't turn your back on the capital of a country. It doesn't happen.
A very smart move, and that people of my generation will remember that, because we tend to think of London prices as sort of continuously meteorically rising. Those of us who were investing in London in the 1990s saw it flatline in some areas, including the areas that I was investing in, for nearly a decade. It was flat. Now, with that injection, I mean, it's a masterstroke, really, with that injection of capital and talent from Hong Kong, that could prevent a recurrence of that in the 2020s.
And looking forwards, Jay, I mean, I don't disagree with you, David, there, sorry. I think it's a very valid point. And also, from an immigration point of view, they've got UK passports, so they don't count on our immigration stats, because they are quasi-UK citizens over in Hong Kong anyway. But looking forward to 2021, you predicted a slightly turbulent, bouncy year because we had an unknown COVID. We didn't know when vaccinations, if they were going to happen, when they were going to happen. We didn't know what the budget was at the time. We didn't even know if Brexit was going to help us. What's your predictions for the remainder of the year? Because based on the things that have changed, and there have been quite strategic things that have changed, a vaccination program where we're third in the world for most of our population vaccinated, that's going to change the speed at which we get back to normal.
Well, yes, assuming that the can isn't kicked to death, let alone kicked further down the road. I think
we'll just drive over it and flatten it.
That's
I mean, while we're on the subject of vaccines, just for a second, it's fair to point out that, firstly, we're vaccinating not according to the manufacturer's instructions with this 12-week delay. So that's a political, not a scientific thing. And secondly, that, there are all these little variants like P1 in the background for which these vaccinations almost certainly don't protect us. So we're probably going to be revisiting this in September with another huge order for another 50 million doses of something. So, not quite done and dusted yet.
It's the same thing.
He's ever the optimist, isn't he? He's ever the optimist, Jay.
Yeah, and as you should be. But it's the same thing with the flu vaccine. No, you still take it once a year, and it has to be re-engineered based on whatever new strain or protection it comes out. And there was a really good documentary I watched a couple of years ago, which is the race to I can't remember what it was called, but it was basically the drugs cannot keep up with the evolution of the viruses, and the viruses, as they adapt to the medicine, become more and more resistant to it. And that's why GPs are so reluctant to give people antibiotics and put them on steroids or painkillers and this, that, and the other. Like, no, seriously, just lay in bed for a week, plenty of fluids, la-di-da-di-da, just you don't need to do it. And that's what they're fighting against. But that's obviously a massive tangent. Yeah. But going forward, and who I'm
2021 property, the economy, and what you think has changed since your original forecast, as opportunities or as threats?
I think as opportunities, I think there are more. I think I was quite aggressive in how I thought Brexit would be handled. I wasn't too far wrong, I don't think. I wouldn't say I got it nail and hammer. I certainly didn't, but I was not far off the mark. Likewise, with the budget, I said that there would likely to be some things that are going to create incentive, because that's what this Conservative government have been trying to do from the start, incentivize. I would never have thought of Freeports, because I didn't have the prior knowledge of them, so that's me out. But the fact that that is an incentive and it's going to create hotspots of growth, I didn't know what it was, but I knew something like that needed to happen. and I'm willing to embrace it. I'd love to see where that goes. So going forward, another thing I said was I thought Q3 to Q4 would be when the the evictions ban was going to come to an end, or the fallout from it was going to start being felt in the market. And same thing with the repossessions ban. I thought that was going to come out, and I still do. I think, with the kicking of the can down the road, maybe not the end of Q3, start of Q4, maybe now the end of Q4, I would expect to see some of that hitting the market. But I know from speaking to asset managers that I do on a fairly regular basis, there is likely going to be a initial kind of burst of activity in and around the July, August, September mark. But that is, the aftershock is going to be so much more. They don't perceive it to be more than the 2008 aftershock, but they are expecting massive levels of properties entering the market. And I discussed it before. I think the more that comes onto the market, the more supply that drowns the market, demand is going to have to take a step back. The truth of the matter is, especially for auctions, there's a 20% to 30% reduction in stock levels. There's no one can hide that. But what is happening is actually the number of lots that are being sold have increased, point for point. The amount being raised and the amount being achieved for similar stock on a year-on-year has also jumped up point for point, and on a year-on-year basis. So that shows that there is activity in the market, there's heat in the market. That for me, the primary factors are, especially in auctions, the fact that everything went online, became easier to access. It's all becoming digital. It makes it easier for people to do. No one has to take a day off work. You can, like, while you're sending emails to John Smith, you can also click the bid button on another screen and you can just carry on with your life. That's made it easier. The fact that there's cheaper, easier money out there. Someone talked to me yesterday about a bridging product that was 7% annualized. So, you go back 2 or 3 years, you're talking about 1% a month. Now you're talking 12%, including arrangement, including legals, including this. And now, bridging is becoming something that actually nowhere near as cheap as a buy-to-let, but you've got things like bridge to let that are coming into the market.
Yes. Yeah.
And which is for a residential landlord or property investor at auction, that's got to make sense to you in any language. So I think it's the ease of finance. I think it's the affordability of finance, and I think it's the fact that actually people have got more money in their pockets. Mm-hmm. I'm not going out every day and having lunch, which is what I would be doing if I was working in an office. I've got to be saving at least £50 a week on that alone. I did like my sandwiches. So, there are things like
Three Marks and Spencer's meal deals a day, Jay. Wow.
There's a comedy sketch, isn't there? I think I can't remember what it is, where basically there's a guy saying, it's coming towards, the end of the month. He's not quite got payday yet. And he's like, I've had to bring my own sandwiches in. 2 weeks ago, I was going to M&S. I was getting a salad, a sandwich. I was even buying the bag. It was frivolous. I'm just throwing money away. And he was regretting it. The closer it got to the less money he had in his pocket before payday. But the reality of the situation is I'm not alone in that. And actually, when things go back to offices, which I believe they will, you will see a resurgence of the high street reopening. So I don't think the high street is dead. It definitely is reimagining itself. I think the additional PDs that are coming in are going to enable a flexibility in the high street that it didn't previously have. Do you remember how difficult it was to get takeaway licenses on a high street?
Will the high street, though, ever regain its finer glory, if you like? There'll be more flexibility, but if, let's suppose, that a lot of these high streets, that a lot of the custom at lunchtime, whatever, came from the people in the offices, well, they won't necessarily be working 5-day weeks anymore. They might be working 2-day weeks, 3 weeks, and that's going to impact trade.
Yeah, I mean, absolutely. But then the other thing to consider is that I'm most likely going to be spending 1 day in the office, sooner or later, and on that day I'll be perfectly happy to treat myself to a lovely. I'll probably go in early morning. I'll go to a Greg's. I'll pick up a coffee. I'll pick up a pasty of some description. Then you'll treat it as a treat day, right? Whatever day of the week it is.
Well, now that you live up north, you're joining us locals, what we do.
Well, there you go. Well, look, yeah, now I'm out of London. It'll be a cheaper lunch.
Yeah, for those who don't know, Jay, during lockdown, relocated from London to the regions. So
yeah, I'm a statistic. I'm a statistic of people who decided to move away from the capital, and for all the reasons that they state. Right, when we were in the first lockdown version 1 and 2, we were in a 2-bedroom flat with no outside space and a baby and 3 cats and whatever else we had going on. Now we're in, for the same kind of money, we're in a 3-bedroom house with a front and rear garden. The house backs onto a park. It's the lifestyle is necessary, and I don't need to be in London. And if I do, it's an hour down the motorway. It's not.
Well, you are in London when you're on Zoom.
Indeed,
well, that's it. You're in London wherever.
But
and
let's
another
go
thing
back
here
to an important thing.
Might I just interrupt for a brief second here? Because traditionally, what you've done, Jay, has been a one-way ticket, a one-way journey that you'd never be able to go back. But I'm not sure that is the case anymore either. With everybody sort of dispersing around the country using Zoom and this kind of thing, it might be that now for people who have taken the plunge, and I've been considering this as well, moving outwards, Midland-wise, that it's not a one-way journey anymore, and that there may be some more fluidity there. And again, HST2 on that basis is 30-20 or something as that comes in.
Yeah, it's. Yeah, I think the way the country is starting to operate, I think people are thinking, not generation rent. If they're thinking generation buy, which is very much the rhetoric on the political level, I think people are thinking, well, if I don't want to buy, I can rent anywhere. I can go to any part of the country and I can do my job from anywhere. And, if I'm employed by someone in London, I still get my London waiting, whether I'm in London or not. So it's that flexibility. I think that's going to be one of the second or third order of effects that are going to come out of this.
Agreed.
Yeah. So coming back to the important business of property here, and without wishing you to disclose anything that might be confidential, because you're a consultant to auction houses. Now, will we be going back in the room, or will auctions stay online? Do you think after 12 months that the model has proved itself, or do you think there'll be a hybrid? Or do you think people will go more to the auction house circuitous route where you've got a live auctioneer talking through the lots? What's your thoughts?
The model has certainly proved itself, and it has really upset the apple cart. It really has. It depends on which auctioneer that you speak to. Unfortunately, I speak to quite a few. There are some where they're like, we don't ever need to go back to a room. Who needs the cost and the aggravation? Who's gonna create that aggravation for a buyer? Come to our room. Well, no, thank you. I don't want to do that. Why don't you just have the bidding thing? I'll just click on the button and click, off I go. And there are some auctioneers, probably the more flamboyant ones, the ones who have been doing the live stream, where you've got the likes of Andrew Binstock or Andrew Brown, or I can't remember the name of the chap at Savills. But there is still a skill in having an auctioneer. And I personally think all of the pre-existing online auctioneers pre-COVID who were doing quite well, I think what they've seen is like, right, okay, the unconditional auction providers have entered this space and completely ruined it. For all of us, there's no going back. And they're all sitting there thinking, right, how do we now do our conditional sale stuff and get the same kind of impact as the unconditional guys? Well, they're gonna be getting auctioneers to live stream their auction. Of course they are. It's the future. There are going to be I imagine a lot of the London auctioneers, just for the sheer ego of it, possibly, will go back to the room. But the ones that I speak to who are thinking about it are saying, look, even if we go back to the room, and none of them are saying 100% they are, 100% they're not, they are going to be keeping that element of online bidding, because the concept is proved. It's so easy to register, so easy to bid, so easy to buy. And the whole idea of auctions is it removes as many barriers to entry, as many barriers to purchase as possible.
And maybe do you think there'll be much smaller rooms as well? Because, there will be people many miles away who would sort of come up for the day or something and make a day of it. won't necessarily need to do that anymore, just for that one lot.
Yeah, I mean, possibly not. I mean, if you think about the profitability of auctioneers during COVID, okay, the number of lots are down 20-30%, give or take nationally. It depends on where you are. But you're no longer paying for room hire. And if you're in London, that is anywhere between 10 and 20,000 pounds for a day. You could have a wedding and run an auction. You know,
is there a story here you're breaking to us, Jay?
Well, no. The truth is, actually, we were using when I was working for a specific auctioneer, we were using the Landmark Hotel in Marylebone, beautiful hotel with the massive orangery and all that stuff, massive room, like a room for 120 guests for a wedding. And basically, the hotels are always very honest with you. If someone books a wedding, you're not having your auction here, because obviously the wedding will have guests that take out rooms, that have the breakfast, that have the room service, that do the la-di-da. An auction isn't that. An auction, you pay the money for the day, people maybe buy a coffee or maybe have a lunch, but it's not the money for the hotels. But you know, if you're tucked north somewhere, you know, you could be, I know a couple of the guys were renting out conference suites in football stadiums, places like that. And it was only costing them, you know, between 500 and 1,500 pounds. And that's very affordable. But you now take 18 months out of that, you're looking at 18,000 to 24,000 pounds saved. The number of auctioneers who stop printing a catalogue, you know, that could be anywhere between a 2,000 and a 6,000 pound saving every auction, depending on how many catalogues you print and the type of gloss finish and all that kind of stuff. So you multiply that over 18 months. They're not doing too bad. Okay, it's not making up for the loss of the lots, but actually, if you take it from a cost versus profit basis, on if you're analysing your business, you're not doing too bad. You're not doing too bad. So it's a case of trying to encourage auctioneers back into the room and all of those ancillary costs, and printing a catalogue, and this and that, and this and that, and the fact that you may not get the 300 or 400 people in the room.
Yeah. How many people these days would queue outside Blockbuster to rent a video if it were still in trading? You know, so kind of people do adapt and go with the flow. And if we can facilitate our customers' comfort, then they're probably going to appreciate that.
Well, that's a brilliant analogy, because the death of Blockbusters was the birth of Netflix.
Yes.
Not Netflix as you see today. Do you remember when Netflix was mail order?
Oh yeah.
Well, you had to order it, have it delivered, watch it, and then send it back. All it meant was you didn't have to go into a physical. It was Blockbusters without the building, right? And then it evolved to, actually, how do we do this? Because they started evolving. Like, no, now it's just an online kind of streaming service. Of course it is.
Pandemic has sort of pushed that evolution. It's turbocharged it.
But for auctions, 100%.
Yes,
and here's the real kicker. There are conversations being taken place with massive platforms within the industry, not auctions, but within the property industry, to mainstream auctions on a conditional sale basis.
Wow.
And that is going to completely change the marketplace, completely. And there are some people that are already operating in that space that may or may not do well out of it. It depends on how they evolve their practices to better fit the consumer, which I don't think they've done yet, but it's on the way. It's all part of the growth.
Wow.
But to answer your question, Andrew, I don't. If it was possible, I still don't think auctioneers should go back into the room this year. I think if you are going to do it, relaunch in February 2022. Give people that breathing space. Give them that comfort. Let the vaccine run its course and get more people done. Because and maybe, like David said, maybe slightly smaller rooms.
Yeah.
But
well, from what you were saying, my analysis here as an entrepreneur, a businessman, an accountant, is there wasn't as much stock, but the sold prices were up on what it was a year ago.
And so
we're in a lockdown, the stock is down because of the lockdown. Are the prices up because of the lockdown, or are the prices up because the guy in Lerwick in the Shetlands is now able to bid on an auction lot in Auction House London or Allsops Commercial. Therefore, you're opening up the market to a much broader audience. And also because it's a bit more like eBay, dare I say, where at the click of a button, you don't really realize that you've just spent the money, and doing the due diligence doesn't seem, from the people I speak to be done in the same way that I feel it should. And it's a bit like online gambling. Oh, it's just another click for another spin. And they're not thinking about it.
Yeah.
Do you think people are getting click happy? Do you think it is achieving higher prices? Because that's what I'm interpreting from you.
Well, yeah, I mean, there's certainly that, but there's also the supply versus demand metric that can't be forgotten. Because the number of properties entered into auction are down by 20-30%, the level of demand of the existing stock that is out there is obviously increased, maybe not by equal parts, but certainly is increased. But yeah, the ease of ability and usability of the online system certainly, yeah, will make it easier for people to bid. And it's like that, you know, it never feels real. I mean, during the
are we talking about that shopping centre again in Real?
Well, you know, there's the one that's going for sale through BidX1 in Cornwall, I think. So I'm keeping an eye out for that one. And there was the one that we talked about on the pre-auction stuff that we do with Anjan and Rod. Yes. The one that's in Scotland. So I'm just paying attention to these things, because these are like UK REITs and massive investment funds who are you know, dumping, you know, what would originally have been, you know, crown jewels, you know, of what they were holding.
Well, the reason they're dumping is these REITs, the Newmarket lot that we discussed a little bit earlier, are owned by pension funds, and they work to a yield, and they guarantee, or near as damn it guarantee, or their performance is monitored based on the yields they deliver.
Yeah.
And if a lot of these shopping centres, as an example, they've had large tenants who've gone through various CVA processes, perhaps had rent payment holidays, perhaps even gone into administration.
Or
it's
the
meant they're not
CVAs.
achieving the yield.
Yeah, or the CVAs.
So they've got to offload, otherwise, when it comes up to renew their contracts as asset managers for the pension fund, they're out the door, and another asset manager is brought in to achieve those yields. So they have to proactively manage the assets. It might have once been a crown jewels, but
on a capital basis, 2 years before that, the White Orchid, I can't remember exactly what it's called. Is it the White Orchid, something like that? The one in Coventry?
Yes. Oh, yeah. Goodness. Yeah.
Yeah.
Let's buy a leasehold shopping centre and give away most of the profit to the council.
Oh, it's council owned, but they're never going to operate it. And if you know, the negotiating power is on the person who will be running it. Because
it's a rent to rent, isn't it?
Yeah, because the local government are going to want to be seeing a return, and the return is down. And bear in mind, their cut was based on the income that was coming in. There wasn't that much income coming in, so actually the cut was down. And you could, you know, if you're entrepreneurial enough, you could negotiate that. I personally would want to take the car park back, because they were running that almost exclusively, and I think that was too much. But what I did like about it was 2 years before, it was valued at like 38 million, something ridiculous like that, and was sold for 5.
Yeah.
You can't build it for 5. Fundamentally, it was a brilliant purchase. Fundamentally, it's a brilliant purchase. What someone then goes to do with it is a completely separate situation. Yeah. In 2 years' time, will it be worth 38 again? Will they sell it for 12? If they do, you'd stand up and applaud. I would.
Yeah. No, absolutely. Well, this goes back to something which I often say is key in any business transaction, be it property or business. And I've done this myself. It's about market timing, and it's about circumstances. And as both of you are well aware, I bought a company off the back of the 2008 crash. I bought it 18 months after the crash because the management team bought it out the day before. I paid 12,400 for a company that the day before Northern Rock crashed was sold for 5.6 million.
Yeah, fundamentally.
And I profit from it still today. Now, why
how do you go
wouldn't
wrong?
I do that? You can't go wrong.
Of course, because and that's the difference between a real market, someone who's making investment decisions based on fundamentals.
Yeah.
There are a lot of people out there who base it on not on fundamentals. They base it on, okay, if the yield is this and I'm in at that, but no, fundamentally, what's the bricks and mortar? What's the, what's all the independent elements around it that impact it?
Yeah, it's bonkers. Some of the things that are happening, and people are looking at it. Shall we say I work with a number of RICS valuers and understand their thought processes, how they've been educated through their professional qualification route. And they don't think entrepreneurial like the three of us do. And it's all about a set of calculations, a yield, and about managing it in a particular way. They don't think outside the box. They're not taught to think outside the box.
The real life
mistake.
Yeah, the real life implementation of what it is that they've been taught is actually it's not a true reflection, which is 98% of the stuff that we do, we don't get surveys, because all you're going to get is and most of it is pro forma. They just put in the independent bits and pieces. They click, they pull down the thing and see how many sevens run across the screen. And there's a lot of that needs to evolve. And actually during this lockdown, there's been a lot of kind of things that have been said about the RICS. They've had that scandal in the same way that the politicians had certain scandals. So pinch of salt for me, I'm afraid.
Yeah, and it's a changing world. So to summarize where we're at, Jay, or would you like to summarize where you think the opportunities and threats are for the remainder of the year, and where we need to tread with caution, the speed bumps that you're anticipating as a property trader?
As a property trader, I try and stick with the 3 V's and the 3 M's. So the 3 V's are volume, velocity, and value, and the 3 M's are the 3 D's are debt, divorce, and distress. So we have to we operate within those confines. So actually, if we're finding good value and we're able to achieve volume and we're doing it at velocity, it's very difficult for us to go wrong. And if 1 or 2 of them go wrong, they wipe their faces with the rest of the volume. The pitfalls in the market is actually when the government protections, and again, I'm of the opinion that they're not going to create cliff edges on the repossession market or on the eviction market, but you can already see the rumblings. I think there was an article from Paul Champolin. I haven't read the whole thing yet, but what I did read was they are anticipating that the UK court system will not, or the bailiffs are not in a position to service what's coming. So, even if the government doesn't kick the can down the road, procedurally and actually dealing with these things, you're probably looking at a fallout of the next 12 to 18 months, minimum. And will there be opportunities? Of course there will be opportunities, but they will not be prime opportunities.
If I can be controversial on you, Jay, there, on that forecast, the evictions might resolve itself. How? Well, if I'm a tenant and I've just run up 18 months worth of arrears, 2 years worth of arrears, I might just pack my suitcase and at midnight leave and do a runner.
Yeah, but how does that help the landlord?
Precisely. That is the point. The landlord is left high and dry, carrying the can, and then ends up with the political hot potato of, being repossessed because they've got no money, they've used all the reserves, and it
or have to
potentially
panic
harms
sell.
the credit rating of the landlord.
Yeah, and probably have to panic sell at a discount.
Correct.
Yes, yes.
So I'm being controversial in suggesting that tenants might do a midnight runner
Well, I
once
think if
they
if
start
they're
to face
smart,
the
they will.
music, and they'll
Yeah,
probably just evaporate into the ether.
So, and where you see that, that is, and David mentioned the sword of Damocles earlier on, is, that's a double-edged sword, because what it does is actually the tenants are going to get away with it. I mean, because by the time you go through a CCJ or try and claim back all the rent, I mean, talk about pissing against the wind. It's just, and maybe it is worth it depending on, whatever's outstanding. But the
That's
reality
not a
of
very pleasant metaphor, Jay.
it's not, but it's apt. And unfortunately, aptness overcomes politeness in most situations. Honesty's at play. But it's as you say, it'll be the landlord holding the hot potato. And it'll be that landlord, the selling landlord, who's holding the hot potato. But it'll be the incoming buying landlord who's buying a distressed, possibly discounted asset. And then you have something that then just becomes an Ouroboros kind of situation where the one is feeding itself, because the new landlord buys it in, gets it rented. The tenant now, who's back hopefully in employment or on some kind of benefits, or whether you're in social housing or whatever the story is, then you start taking on the asset and it is yielding. And then the other landlord then has to find a way to recover from that. They'll start having to invest in other landlords who have distressed assets. And it then becomes something that starts building itself up out of the ashes.
I mean, you remember in infrastructure projects like the American Railroad, all that track and everything was rolled out. Most of the original investors lost their shirts, but then people came in and bought it at 10 cents in the dollar or whatever, and it was business as usual.
Yeah, I mean, this is markets, economies are massive ecosystems, forests, and sometimes a forest will strangle itself from overgrowth. The only way for it to survive is for it to be burnt down, and for the green shoots to come out and rebuild it. And I've mentioned it already. Obviously, the Phoenix effect. Hopefully, it is nowhere near as doom and gloom as that. That's a fingers crossed. I know a lot of portfolio landlords that would feel very uncomfortable with this part of the conversation. But hopefully they're the type of
the
landlords.
point I'm making is there is opportunity potentially there, albeit that it's an ill wind.
Yeah, and if you are one of the landlords where you are dealing with all these difficult situations and the tenants leave, if you're in a position at the same time to buy new stock and get that stuff coming in, you could try your best to wipe your face and make sure that actually if you're at nil loss and nil gain for a year or two, you're in a privileged situation potentially. But that's all the doom and gloom stuff. Will it all come to pass? I don't know. What I do know is that the government is still very much anti-investor developer, landlord investor developer. So maybe they're going to...
It's ironic they're anti-developer because the target is 1 million new homes or dwellings by the next election. Hence, today, 31st of March, the date we're recording this, the new permitted development rights have just been announced 2 hours ago. And because they have just been announced, they are encouraging developers to develop the high streets.
Yeah, so it's developing homes for the average person, not developing homes for the average investor.
Absolutely.
And obviously, there's an element of I don't know how receptive the government are going to be to the build to renters anymore. I don't know. That's going to be an interesting side play. I don't know how encouraged they are by the whole rent to rent thing. That's heavily under kind of it's Wild West. There's almost no oversight on that part of the industry itself. So there's a lot of things to consider. But in reality, I think there's going to be more opportunity than not. And I think, the government will be putting things in place for the average person to succeed, but maybe not the average investor landlord to succeed. So they'll be seeing these repossessions coming to the market as a benefit to the average buyer who's buying the stock that wouldn't have been available to them previously.
The thinking behind this, isn't it, is some tenant voters in certain marginal constituencies that have to be wooed. But if the government overreaches itself, and if these anti-investor, anti-landlord measures reach a point where too many people quit the market, then town halls are going to see mile-long queues on the steps of people seeking accommodation that they're simply not able to provide. And then pressure will cut feedback from them to Westminster saying, you know, oh boy, hold on a bit. And look what happened in Southern Ireland when they introduced the sort of tax restrictions and everything and had to wind it all back again.
It needs to be remembered that investor landlords provide an essential service to the country. Essential, because there is no longer swathes of the country which are government-owned housing. The average landlord investor is propping up the government on that basis. They also take properties that are unmortgageable and make them mortgageable, make them habitable. They provide housing. Okay, there's bad apples, but there's bad apples in every industry, in every market, everywhere on the planet. You can't tar everyone with the same brush. So there is a lot of that needs to be respected. And you're right, it will require a balance to be struck. But God forbid this government or the previous two were in a position to do it. I hope they are, but I don't hold out much hope for that.
Well, on that note, it sounds like we're coming to the end. Jay, any final pearls of wisdom that you want to share?
God, that would implicate me as being someone of wisdom. I tell you what,
Socrates.
Yeah, I tell you what, the two bits of advice that I've been giving recently, because a lot of people I don't feel have been doing any real quality due diligence. So 2 points of due diligence I recommend everybody do. Step 1, Google the full address of the property. It's the most basic thing. That you know how many investor developers I know that the first thing they do when they see the address is they just stick the postcode into Rightmove. It's not the same. Google the full address. The second thing I recommend you do, whether you're looking at doing any development, any value add, anything at all, stick the postcode into the planning portal and see what other people on that road have done, because it may give you an idea that you didn't have previously. It also will tell you what people have been refused for and why they were refused, which means you can go in with a fresh application dealing with all of those refusals and give yourself a better opportunity. That's my 2 pennieth worth.
I think they are 2 absolute golden gems of advice, Jay, and I 100% echo them. And the only thing I would sort of add to that is check and double check. I was supporting an investor who was looking at investing in a project, and he'd gone to a planning consultant who'd said, yeah, you could do this. The day before they submitted their bid, they found out it was in a conservation area in a flood zone. And they couldn't do what the planning consultant had told them they could. So even though it might be a professional, check, and double check. The responsibility lies with you to make sure that you have asked all the right questions. David, any pearls of wisdom? Just summarizing what Jay said there.
Well, one little thing, coming back to what we were saying about some landlords being very distressed in light of the repossession ban and other matters. I found myself a bit peaked, shall we say, during the credit crunch when I had to dispose of some property at a kind of about half price. But rather than sort of wailing and gnashing of teeth and all that kind of stuff, whatever that means, what I did, I realized that meant that other people in the same position were having to sell discounted properties. So I went shopping and I bought some real prime real estate, better than the dogs that I've disposed of. So there's always opportunity that comes out of crisis.
Yeah, well, that's very smart. Jay, it's been a delight talking Brexit, which we won't need to do on the next update. Budgets and how Rishi's budget has created opportunities, planning and COVID. the repossessions, evictions, stamp duty, how politics not price it. Politics drives prices, not prices chasing a market. How the government's moved to the regions, and about auctions coming back into the room. So we've covered an awful lot there. Freeports being a new area of research for you. And the next time we meet, I look forward to your analysis on where the opportunities are in Freeports that you have seized or are seizing. So for now, Jay, I would like to say a massive thank you, Mr. Jay Howard of Hammered, property auction consultant extraordinaire, and his business partner, Piotr Rusnik. I'd like to say a massive thank you to my co-host, David Clouter. It's goodbye from me.
And goodbye from me.
It's goodbye from them.